Good evening friends, welcome back to my channel AAA Easy Trading and Investing with Thapa. Today we are going to discuss about company name HDFC Bank. Friends, HDFC Bank, India's largest private sector lender, has been under severe pressure in March 2026. The stock has fallen over 10 to 12% in just 4 trading sessions, wiping out nearly 1.6 lakh crore in market cap, with shares hovering around 782 levels as of late March. The immediate trigger was the sudden resignation of part-time chairman Atanu Chakraborty, who cited that certain happenings and practices over the past 2 years did not align with his personal values and ethics. This unexpected exit created massive uncertainty and triggered heavy selling. On top of this, earlier concerns like slower deposit growth compared to loan growth, high credit deposit ratio nearing 99%, and lingering integration challenges after the HDFC Ltd merger have kept sentiment weak. Over the last 3 months, the stock has corrected nearly 25%. Many long-term holders, including me in my personal view, have been sitting on losses for almost 2 years now. But after deep analysis of 40 years in company evaluation, I see this as a classic opportunity. HDFC Bank remains a rock-solid franchise with unmatched scale, and current levels represent dirt cheap. HDFC Bank's core numbers remain impressive despite the noise. In Q3 FY26, standalone net profit rose 11.5% YoY to 654 crore, beating estimates. Net interest income grew 6.4% to 620 crore with NIM at 3.35%. Deposits grew 11.6% YoY to 6 lakh crore and advances 11.9% to 4 lakh crore. Asset quality is best in class. GNPA steady at 1.24%, ex-agri 0.97%, NNPA tilde 0.42%, and capital adequacy strong at 19.9%. Valuation is where HDFC Bank looks extremely attractive today. Current PB ratio is around 2.1-2.3x. Compare this with history. Its 5-year average PB has been approximately 3.09-3.58x, with median around 3.4-3.58x, and even the 3-year average sits higher at roughly 3.1-3.3x. The stock is therefore trading at a significant discount of 35 to 40% to its historical norms. PE ratio is also reasonable at 15.8-16.5x against past averages above 20x. This is not cheap by accident. The market has overreacted to temporary issues like deposit slowdown and the recent chairman news, but HDFC's RE of tilde 14%, consistent 15 to 16% earnings CAGR potential, and pristine balance sheet make current valuations dirt cheap for a franchise of this quality. When you compare with Kotak, higher PB due to wealth premium, or IDFC First, cheaper but riskier, HDFC offers the best risk reward at these levels. For anyone thinking 5-10 years ahead, this is a rare entry point into India's strongest private bank. Risks exist: regulatory scrutiny, further deposit mobilization pressure, and possible short-term volatility from global cues or merger overhang. However, the bank is already addressing these. Deposit growth is stabilizing, asset quality remains pristine, and capital buffers are healthy. The recent chairman episode appears more sentiment-driven than fundamental. Buy aggressively at current levels and keep accumulating on every dip. If you are already holding like many of you for the last 2 years and sitting on losses, this is the time to add more. HDFC Bank is a proven long-term compounder that will deliver superior returns over 5-10 years as India's banking sector grows. At today's dirt cheap valuation, it offers an outstanding margin of safety with huge upside potential. Friends, this is a high conviction idea for patient investors. Like, share and subscribe for more deep analysis. Comment below. Are you buying more HDFC Bank? See you in the next one.